SVB thing was such an anomaly because they had some very large venture capitalist clients that were all in relationship with each other and all connected by their cell phones. So when one person says, I'm going to do this, and the other person says, that's a good idea, and that starts running through the text string,
smokes.
And then nobody wants to be the last guy on the bus, $40 billion goes out in one day. I don't think any bank is built for that, right?
Yeah.
Welcome back to Get in the Cash Flow Game with K&K, where we talk about investing in real estate, cash flow, building wealth, and all the lessons we learned along the way. And if you can, do me a huge favor, please like and subscribe this podcast, share it with your friends and family. That way we can continue to bring you value every week and get bigger and better guests on the show.
All right, guys, welcome back. So I got a good friend in the house. I'm excited. Sean Puckett, Cal Private, is in the house today. What do you think we're going to talk about? We're going to talk about banking, the banking crisis. Sean's going to give us a little insight of what exactly is going on from basically Sean's a talented banker. Let's be honest here, guys. He's been doing this 23 years. I'm 20 years, so you got me beat. Crystal's 20 years. We were just talking and laughing. If you've been in a business for 20 years, 23 years, and you're not talented and you're not a rock star, you're doing something wrong. So, but Sean's a great guy, good friend, and excited to have you on. Sean, thanks for coming on the podcast.
All right, Kenny, thanks for having me. Fired up to be here. You guys are doing great things with this podcast, getting information out. And I hear from a lot of people in the community how grateful they are for the information that you put out there.
Sweet.
So you guys are doing a great job. Thanks.
Well, that's why we do it. That's why today, I think this is big. This banking stuff is affecting a lot of us, as you know, locally here. It's affecting a lot of people nationally. And also it's affecting a lot of people because they're scared, they're nervous, they don't know what's going on. And we hear all these things. And to us, they're just things. But to some people like you actually know what's going on. And it's easier if you can have more confidence or less because you know exactly what's going on. So real quick, if people don't know you, can you give us just a quick little backstory of kind of how you got here today? And then when you're done with that, just jump in a little bit about what you got going on over there today at Cal Private Bank.
Yeah, right on. Like you said, 23 years as a commercial and private banker. I've worked for large banks and then gravitated and graduated to working for community or private banks for obvious reasons. I'm a formally trained underwriter, so I can strip down financials and create my own loan without a whole lot of help, which is beneficial to my clients because we can sit down and have a conversation over numbers and I can tell them with 95% accuracy exactly what the bank's going to do. So people like that. So a lot of my clients I've had for a decade or more, right?
Awesome.
So, you just build over the years. And my clients really fit into two buckets. They're either founder CEOs of companies.
Cool.
So they're running a business and I'm helping them get capital to keep scaling that business and doing a lot of other things for them on the operational side and everything else to make sure that they're successful. And then on the other side, I've got the other 50% is just like pure real estate investors. And as you know, and as you and Crystal do, you know, most people build their wealth in San Diego through real estate investment. And that requires a very sharp banker. It requires a very responsive bank. And it requires a team that can get things done immediately because in the real estate world, as you know, sometimes there's fires and we gotta act fast. So.
Yeah, I mean, especially here, people do. I mean, we're lucky. I always tell people in California, we have a really good bank, a lot of banks here. Like if you start going outside of California just to lend, they don't have the banks we have here. Especially SoCal, people love to lend here. You know, if you're like lending on apartment buildings, it's pretty safe as long as you're not going crazy, right? We had somebody in here, chief credit officer, and he's like, our whole portfolio is Southern California apartments. I mean, we're fine. We're good. You know, he's like, we're good. So that's the other thing is when you go small local bank, they understand the local market, right? So if you think some people go, the deal doesn't make any sense. Well, Sean's like, well, I know that street and that corner and we have clients there and that deal does make sense, right? Yeah. So that's what being like at a hyper local level, these small banks, that's what people that don't have that option or understand what is the big deal about these small banks? Why do we need them?
Yeah, well, that's a good point. And that's where my market is, right? Coastal Southern California. So the collateral is safe, we feel. And then even to go beyond that, you asked me what I do. A lot of my real estate clients, they want dry powder lines of credit, right? So they've got unsecured line of credit or a real estate secured line of credit that they're just waiting for the next opportunity. And we sort of believe in their mission. And we believe that if they're acquiring real estate in Southern California on a downswing, we're all going to be good in the long run. And then I kind of take it a step further. We have clients that are looking at stuff out of market. They live here, but they're buying stuff in other states. So we lend on that too.
That's awesome.
Because if our relationship's here and we know what their business plan is, and that's the key, is like, what's their business plan? What have they done and what are they trying to do? And if it all makes sense to us, we want to back it all the way across the country.
So let's jump into that. As you know, I think let's just start off because I wanted to have you here today to talk about banking because it's obvious on everybody's mind.
Yeah.
I think a lot of people just don't pay attention to their bank account, their banker, their checking, savings. Where am I? All of a sudden,
they're
boom.
paying attention now.
Yeah, right? SVB hits. All of a sudden, everybody kind of like, boom, just stopped. Yeah. Everybody thought, people don't understand. We'll go first. We'll talk about what a run on a bank is. But basically what happened is people freaked out and started pulling, $40 billion or so in 24 hours out of a bank. So first, let's just jump in. I know people probably know what it is, but what in the world does it mean when somebody run on a bank? What does that mean? Because some people might not know what it means,
Yeah, I mean, the simplest answer is when a bank has clients' deposits, those are liabilities. They owe those back, right? It's not an asset.
It's crazy. People don't know that, right? Yeah.
Loans are the assets. The liability is the deposits. And banks aren't set up to have everybody come in and take out their deposits in one day.
Yeah.
It's not built. The whole American banking system is built on depositor trust, right? That they trust that the banking system is going to keep their money safe. So, the SVB thing was such an anomaly because they had some very large venture capitalist clients that were all in relationship with each other and all connected by their cell phones. So when one person says, I'm going to do this, and the other person says, that's a good idea, and that starts running through the text string,
smokes.
And then nobody wants to be the last guy on the bus, $40 billion goes out in one day. I don't think any bank is built for that, right?
Yeah.
And so that was very damaging to Silicon Valley Bank. But hey, I know there's more to the story behind but the financials of the bank and why they might have done that. But at the end of the day, a run on the bank is when too many depositors want to pull their money out in a very short amount of time. Now, if it had been a week or 2 weeks or whatever, banks also have credit facilities. They have lines of credit. They have access to capital so that if they do get some big pulls, they can replace it to keep their balance sheet tight, safe, and in compliance. If it's too big of a pull too fast, they can't react quickly enough.
Yeah, they got many options. They go to the Fed. They can go to, I'm drawing a blank of what the short term where banks lend to each other, the repo market, right? There's all these facilities that people, I'm not trying to confuse you guys or listening, but there's many facilities, but in one day, it's hard to go get that
But you want to define a run on a bank. I mean, the classic is in the Great Depression when everyone was like, I'm not going to be able to get my money out. And
they're standing in line.
In line around the block to get
this
their
one,
cash.
you just say wire it out. That's the difference.
That's the difference, right?
There's no standing. The guy at the back of line's like, I'm going to get screwed here.
Yeah, the old school run on the bank in the late 20s, 30s, whatever. The bank could react and say, okay, we're not giving any depositor more than $500. Like that's just what we decided today, and they can kind of protect it that way. Today, like you said, with wire transfers, it's different. But I don't want to create fear in the market.
I mean, it's
that was such an anomaly.
But the government came and just took the fear away and said, "We got you guys."
Right.
Basically, so what they did is they came in and said, "We got it.
Yeah,
we got you covered."
Yeah,
which is crazy, but they don't want the fear. And with social media and how fast things fly out there,
right?
Let's be honest, a lot of this fear, like you said, was texting.
Yeah.
In the 1920s, you guys couldn't text your buddies. Yeah. You'd have to go ride the horse. So the message, the problem today is we all know the message gets there in seconds instead of a day or a week or whatever, right? So that is the problem. Social media didn't help, all this stuff, and everything went viral. So with that being said, let's talk about bank covering deposits, right? Because we know, I think by now everybody's like, the dust is settled, we're all good. I think we understand what a run is, but also the government did come in and say, hey, we're gonna go ahead and do it. But let's go back to there's FDIC and how that works. Because we were having a conversation here. You were in here a month ago, and I think we all kind of discovered, I didn't know. You're like, oh, did you know this and that? And Chris and I are like, what? So can you kind of go through is it 250 or could it go higher or is it different with more people on? And these are some of the things we were walking through, which is interesting to me.
Yeah. So let's define FDIC insurance coverage as $250,000, right? That's the number everybody sees. And they assume that that's just how much they have in a bank. But it's a little bit more complicated than that. So in your business account, $250,000 is covered under that entity, okay? But if you have a personal account with 2 signers, right, joint ownership, now that's $500, right?
Wow.
Now, where a lot of my clients and your clients have trusts, they have beneficiaries on that trust, all the people named on that trust get $250. So if you have in a bank account, say you got 3 kids, 2 parents, now you're up to $1,250,000 on that. It gets even, you can get even more insurance coverage by doing, a joint personal account that's connected to the trust, and it kind of fans out from there. The other thing people don't realize is it's at the entity level too. So say a real estate investor's got a few different properties and they've got money in these different LLCs, those are different entities, right? That have different coverage. And then I think one of the most complicated thing is if you think about an escrow company or a client trust account for an attorney.
Oh yeah.
Where they're holding other people's money, or a property manager, they're holding other people's
too.
money. Yeah.
A lot.
And it's all in one bank account. And then you put a $250 on it and everyone panics. No, it doesn't work like that, right? All the people that are connected to that company, and that because it's their money, right? So that spreads out that FDIC.
So your property manager has $10 million, has 100 clients. You can,
Yeah.
Okay.
The other thing I want to say about FDIC insurance is the FDIC serves its purpose, but their main source of income is charging banks for this insurance. So all these depositors are getting this insurance for free, right? But the bank's paying for it. And so I just, word of caution out there, the importance of FDIC insurance, it is a revenue generator for the FDIC. That's really part of what's behind it. And the reality of a bank just failing and everyone losing their money, that hasn't happened since the Great Depression. And I don't know if you want to talk about how the modern banking system works. Same as insurance companies.
Yeah, no, let's talk about it. Yeah.
If a bank is not doing well, right?
Yeah, they have options, right?
Yeah, the classic scenario is what we just saw with First Republic Bank, right? Okay. The FDIC came in on a Friday night, over the weekend brokered a deal. Monday morning they opened as Chase.
Jamie Dimon owns it.
That is the classic modern day banking transition.
Why do they do over the weekend? Somebody mentioned, I forget.
Because they don't want to scare the depositors.
Oh, you can't remove your money over the weekend.
Yeah, it's all about keeping the faith in the banking system, because that's what this whole country and the world is built on.
Yeah.
You start breaking down that confidence and that faith.
Problems.
Massive problems, right?
Yeah. You can't fund things. You can't, I always tell people, I think it's 80% of purchases are done with debt, credit card, lines of credit, whatever, right? And people go, well, I'm
all intertwined.
Yeah, you have to have it. So no banking system. Yeah. There's no debt system, right? Yeah. So
that's why I'm happy to talk people through FDIC insurance coverage. And then there's also even more exotic ways to get more coverage. And if you don't know, if you're listening and you don't know, if you have money at 3 banks and you just have your own personal account, you can get $750 across 3 banks, right?
Yeah.
So there's a way that if you just have a primary bank that you're comfortable with, you can get an account through your bank, and then they can go farm it out to the other banks through a couple of programs, CEDARS and ICS. But again, I like to educate people. I'll talk them through it. But at the end of the day, the modern banking system is set up so that banks don't lose people's money.
Yeah.
It's not going to happen.
They learned that from the Great Depression, basically. Yeah. Do that once, you're not do it again.
Exactly.
Let me, real quick on that. So because there's a lot of stuff going on too, is how banks lend, and right, there's a lot of people say, oh, banks, we deposit the money, I deposit $100,000 in the bank, and then that is actually a liability to the bank.
Yeah.
And then they could take that money and leverage it to, I don't know if it's 9 times, 10 times, whatever it is, and then they can lend on that money. Can you talk about how banks are able to lend? You're at a small bank. How do they lend? How can they go lend somebody $10 million? I don't think people really understand this,
Yeah. Banks have to manage their balance sheet, right? Okay. So I think the question you're asking is how do banks manage how much they have in deposits and how much they can lend?
Exactly.
And why are we having the conversation now, today, about this bank's not lending, this bank's lending?
My point, that was the next question.
Just a year ago, this bank was lending full speed. Now they're not doing those kind of loans. What's going on, right?
Literally, some banks, guys, are literally not lending. Yeah. They're just stopped. Yeah. Sean knows bankers, we know bankers, they're twiddling their thumbs, just calling clients and just waiting.
Yeah. So the way that it works is banks have to maintain a ratio between their deposits and loans. What they can actually lend out, leverage-wise, is much higher than what they actually do.
Okay.
Banks want to stay in between, I would say, a 90 and maybe 110% of deposits.
Okay.
If you start getting down into 60, 70% of your deposits are in loans, it's not profitable.
Okay.
So you're really getting up there to that 100%. Banks go up to 120. They could go higher, I think. But they're all pretty similar, you'll see, in that 80, 90, maybe 100.
Okay.
But how could you come in and get a $10 million loan, but you have $500,000 in the bank?
Yeah.
Right? That's
Yeah.
That messes up the balance sheet, right?
Yeah.
Well, there's a whole bunch of companies that bank at banks or people that don't borrow money too. And so their deposits help fund the loans. And when the government was pumping out PPP and EIDL money and everything, the banks were pretty loaded up with deposits.
A lot.
So they were creating loan departments that were just firing out low interest rates loan as fast as they could so they could keep their profitability up. Some banks were. Some banks weren't. Some banks were just staying true to their traditional business model. Now that the tide's gone out, we see who's wearing the swimming suits.
Warren Buffett, yep.
Right?
Okay. So there are some banks that just went very aggressive, low rates, hit the, red lined it, 6th gear, let's go, lend.
Yeah.
And then all of a sudden rates come up and now they're dealing with the repercussions of whatever that looks like with their balance.
Right.
Okay.
Right.
And there's some banks that are like, we're just good at slow and steady here.
Mm-hmm.
We don't slow and steady wins the race. We don't need to be the lowest. We don't need to be the highest. We're right here. We're lending. We're comfortable, and we're just kind of doing our thing.
Yeah, that's right. Cal Private's an example of that.
That's
We've been very disciplined about the interest rate we charge. We've been very disciplined about having relationships with our clients, not doing transactional loans. And now that we're here today, it's good to be us.
And use the word disciplined.
Yes.
That's literally the word. That's what people don't understand. I think people running banks, they just kind of went off their discipline. They went, let's go a little harder, let's this. Because a lot of people, let's be honest, people did not really think we're in this low rate environment for a long time. Rates, okay, they're going to go up, but not that high.
Well, yeah, nobody saw this coming.
Not one person predicted. No. Maybe one guy, some economists said this, but I listened to a lot of stuff. Not one person said, they're going to raise 500 basis points rates in a year. It was like, okay, the Feds came out in November of 2021 and said 75 basis points next year.
Yeah, that's what I thought. I thought we'd be somewhere in the
75 to 150.
1 to 2% max in 1 year. Is what
500 basis points. And that's what people say. You want to know low rates, high rates. So basically, that's kind of what's going on is basically some banks are pulling back, recalibrating, right? Mm-hmm. And just having to wait. And so they're just stacking cash, trying to get people in.
Yeah.
And I guess banks entice people to deposit money through a couple different ways. Obviously, you might go move because Sean's a great banker and cool. Number 2 is because I can offer you a money market CD or something like that, right? And just entice you that way to bring money in. Mm-hmm. So when money goes in a CD or a money market, same thing. Is it all the same as a checking or is it a little bit different? Or
yeah, a money market or a CD or a savings account is going to give you an interest return.
Yeah.
Right. So checking account, some of them can give you interest, but most of them don't.
And rates are higher too, because if the banks are lending off deposits, they have to pay you your return of your money, right?
Yeah. So I think what you're getting to, and I want to make sure all the listeners understand this. So any business person can understand this. Let's say you had a loan department that was doing 3.5% loans. Okay. And the money market rates and the rates that the clients or that the banks had to pay out to the clients was very low, maybe 0.5% or whatever.
Which was like a year ago. Or
so let's just say the cost of funds for the bank was 0.5%.
Okay.
And they're making 3.5% loans. What's their profitability? It's 3%, right?
Yep.
Now, if that's a 30-year fixed loan or a 10-year fixed rate loan, that loan is producing that 3.5% for 10 years or for 30 years. What happens when the Fed raises rates 500 basis points? Now, when the bank needs to go out and borrow money to do more loans, or they need to pay CD rates or whatever, and that new number is 5% being paid out on the interest, and you've got a 3.5% loan over here, is that a profitable business?
Yeah. Yeah.
So the more super low interest long-term rate loans that smaller banks did, that's put them in a position with the interest rate environment now, it's hard to dig out of that. Now, a lot of community banks do variable rate loans that adjust every month, and they do shorter term fixed rates, like 5 years, to protect against that scenario that I just said.
Because they only have to survive so long. They don't have to go, how are we going to survive 10 years?
Exactly.
That's why a lot of people, I tell people, the portfolio banks, now they want to lend 3, 5, 7, they're cool. What? They don't want a portfolio 30 or why? Because like you just said, maybe right now the portfolio is 7%. That's probably good for if we're at the peak, right? But yeah, anybody doing these short term, they're getting this income in, but that's not really helping. Yeah. And you have to pay out.
You can't put big national banks in the same box as a community bank because they have a lot more income streams and a lot more levers they can turn. But your local community banks, they have the interest rate that they get on the loan and then how much it costs them on the deposits, and that's their net interest margin. And I'm really proud of ours is 4.9%.
Wow.
And that's why we've been able to have record earnings last quarter and last year.
And speaking of loans, 60% of small business loans are done by small banks.
Yeah.
They're not done by the big banks.
Right.
So it's the hyper local. I always say that it's the person that wants to start this local business, or the real estate investor, or lines of credit, all this. It's done at a local level. So that brings me to the next point, is the small business owner, right?
Right.
So this is where I think SVB, a First Republic, people are waking up and saying, okay, this potentially could change my business. This could hurt my business.
It already has.
Yeah. And now they're going, I need to go find a great bank with a talented banker, right? Literally. Mm-hmm. There are a lot of people out there looking right now. You're inheriting new people. Other banks are inheriting new people. But how has this affected, just like, for example, how is it affecting small banks from lending, like with you or whatever? And what is this small business owner that's sitting here listening, like what option they do? If they're at a SCB or at a First Republic, or they're at a bank where it's like, we're not lending right now. They're like, but I need money.
Yeah.
I have to have that line of credit to keep my business going.
It's even worse than that, right? Because maybe they don't need new money, but maybe they rely on their $500,000 line of credit.
Yep.
And it comes up for renewal, and the bank says, we're not renewing it. So
They'll do that.
It's even worse than that, right?
Yeah.
So you just said that 60% of small business loans come from community banks. Do you see how dangerous it is for the media to be putting pressure on community banks?
Oh, for sure.
Do you see how dangerous it is to make clients and companies scared to have money in community banks? What that trickle down effect is? It means that less small businesses are getting financing to grow.
And that number is on the average.
Yeah.
It could be a place, San Diego, it would be 75 here. I don't know, but that's an average.
Yeah, or middle of the country and like a really low density population, 80. It could be 100.
Yeah, I can tell you like a Palm Springs desert, that's probably way higher, right? Because it's harder to get there. Like, good point. That's a good point. Yeah.
Yeah. But so if you're a small business owner, I would say just, pay attention to what bank you're with, and make sure that you're having a proactive conversation with your banker or with the bank about, renewing your line of credit or whatever your next business plan is. But what happens when, this all goes through cycles, right? So this happens from time to time where banks pull back on lending, or now they're not lending to this industry, or whatever. Those can be balance sheet related. The bank may
when the pandemic hit, they pull back. I mean, they didn't know what the heck's going on.
Right.
Fear. Hello, I don't know what's happening.
Yeah.
That's kind of right now.
Yeah. And so if there's, fear in the bank, or they're not sure what the future is, or they're looking at a new cycle, or they don't have enough deposits to keep lending, right? When that happens, then now there's fewer banks lending, and there's fewer bankers like me that can get things done, right? So you, as a business owner, you really need to make sure that you are having that conversation with what's happening 3 months from now, 6 months from now, on your line of credit renewal or on your next growth project. And, unfortunately, sometimes people have to change banks. Sometimes they have to change bankers. If the bank can't do what they need them to do, then they've got to.
I think you're going to see a lot of that right now.
I'm seeing a lot of it. I'm busier than I've ever been.
It's not just like the SVB thing and all that. Before that, banks were slowing down. That's what people understand. SVB just, in the First Republic, it just hyper focused it and made people, banks already. Yeah. But before that, you and I know banks were already not lending.
Right.
This
were
is
slowing down.
This is last year. Mm-hmm. This coming into June, July, August, I remember Crystal, all of a sudden, rates were going up, and all of a sudden they're like, we're just going to turn this thing off, because they're already looking at their balance sheet. They already knew. Yeah. So people were already like, I guess, are looking for somewhere else. Yeah. So that's a good point. If you're on with the bank and you got your line of credit coming up, whether it's a year, 6 months, 8 months, you should start having a conversation, because they might be, oh, I don't care who you are, we're just not renewing.
Yeah.
What? Yeah. You got to start interviewing. You might start going elsewhere.
So you asked me this earlier, and I want to bring this up. It's like, how do you know if your bank's healthy? How is it doing?
Yeah.
All this kind of stuff.
Yeah.
All banks have to report this stuff. So everybody can see how a bank's doing. All you have to do is go onto the FDIC website and look up the call reports. There's an area where you can see call reports, which is basically like quarterly reports from banks.
Okay.
You type in your bank's name and start looking at the call report. If you know how to read financials at all, you can start to see what the trends are. And then you can also look at their quarterly press releases that talk about profitability. And I would tell people that want to research banks to really zero in on their deposits right now. Are they growing? Are they shrinking? And their profitability and their net interest margin. Right? What's their net interest margin? Loans, how much they pay in deposits. And everything can be found out in trends. Right? So if it's kind of fallen off of a cliff, any of those areas, that would be cause for concern. But yeah, you can do your own research, or you can just call a good banker and have them help you.
Yeah.
Yeah.
For sure. You know, I mean, you made a comment earlier. Obviously, I know it's just kind of like people selling stories. All the small banks are going to go away.
Yeah.
I mean, it's, you know, we were talking earlier, I think it's Canada or something has like 5 big banks. It's not good.
Yeah.
It's like, it's not good at all. I don't know how many small banks there are, but there's thousands, you know? So I just don't think small banks are going to go away for the reasons we just said. They just help so many people at a hyper local level.
Yeah.
And like you're making a good point, we're in a big city, San Diego, but you go to a smaller city.
They don't have a big bank
The
presence.
small banks are really doing all the deals. They could, I mean, they could be doing 80, 90% of the deals. So
yeah.
it's problematic. But one question I want to ask you is we were talking about, and I deal with the same thing because obviously I'm a loan officer, is how are you helping clients navigate high rates? Because, you know, I understand if you're buying a house, you close, cool. You can just do a refi when rates drop. But if you buy an investment property, you could have short-term loan, long-term loan, you have prepays, you have to hit certain, you know, debt cover ratio and things like that. What are you doing to help your clients, or what kind of conversations, or is there any suggestions, anybody listening from a banker saying, hey, Sean, you know, I was thinking about, man, I'm looking at a high line of credit, super high, like this is crazy. You know, a lot of people having to make tough decisions now. Should I not go forward with this development because the interest rates are 9-10% because SOFR plus this? Should I not get the line of credit? So a lot of people are struggling with the high rates because, let's be honest, a lot of people they haven't seen rates ever like this. This is crazy for them. You know?
Yeah. So banks have their own compliance that they have to. So let's just say an apartment loan.
Yeah.
Right. The debt service coverage ratio with the net operating income has to meet a certain number.
Yeah.
And if it's below a certain number, the bank shouldn't have it on their books.
Yeah.
Right.
Yeah.
So now that interest rates have gone up a lot, we're seeing when a loan matures and has to be refinanced, or somebody's buying something, or they're coming out of construction and they're doing that, we're seeing those debt service coverage ratios push the loan sizes down. So what can people do about that, right?
We've been working on this for the past few months. You know, we always want to bring as much value as we possibly can, and our partner, Prime Corporate Services, is all about bringing you a service you can't get anywhere else at a price you can't get anywhere else. Whether you're new to owning a business or owning a property, or you're an experienced property owner or investor, Prime Corporate Services is not only going to help you, but they're going to make the process so much easier. So if you book a call, the first thing they're going to do for you is help you understand what your business structure should look like, your corporate structure, tax planning, estate planning, all of that. Maybe you're saying, I'm brand new to starting a business and all this sounds foreign and complicated. Remember, this company helps new people just getting started every day. They're going to help you form the entity that's best for you and walk you through the process. Before I found this company, we paid thousands of dollars to other attorneys, CPAs, and consultants to try to understand exactly how we need to be structured to be as protected as possible. We've also gone the other route and used online platforms to form entities which unnecessarily put us at risk. You guys, you don't have to do that with this company. They'll do all of these things for you at a reasonable price, so you never have to think about saving money at the expense of exposing yourself to liability. We've searched high and low, and you will not find this much value anywhere else. All you have to do is schedule a free call today. Just go to primecorporateservices.info/GITCG. Once again, that's primecorporateservices.info/GITCG. We'll also leave the info for you in the show notes.
I'm going to tell you a story about investor A and investor B.
Perfect.
And you tell me which one you think is going to be successful navigating this.
Okay.
Investor A never took the time to make a relationship with a banker. They just go get their loan from whatever bank that they can find.
Chasing rates, basically, it sounds like.
They get introduced to a private professional banker and they say, well, why would I bank with you? I can just go online to Capital One or wherever and get 5.5% for my money. So what's the point?
Okay.
Now let's go to client B. Client B has a professional banker. That banker knows what their business plan is. They've done some loans for them before. They keep all their money in the bank with that banker. And now they're facing a situation where the debt service coverage ratio on the renewal is not going to meet, right? Is client A or client B going to have success?
Yeah, B for sure.
Right?
Because you can go to bat for them. You can do
100%. You can go to bat for them. And that's how banks are built, is they're built on skilled technicians like me going to the bank and saying, we know this customer. They've been good to us. Now it's our turn to be good to them. And I just got out of a meeting this morning where we were talking about that. We're already forecasting loan renewals, squeeze DCRs. What are we going to do? How are we going to make it right for the customer? Thinking about them first. Knowing
That's
that
awesome.
They're coming up against this hardship, we're already putting the list together and being proactive about how we're going to make this as easy as possible for them to protect the relationship, to honor the relationship, and to make sure that we all work through this together.
Yeah, I mean, that's because a lot of banks are not going to do that. It's kind of like tough shit.
Yeah.
This is life. Yeah. So that's why I think people, I always say this, in these times, having a good loan officer, having a good banker, having a good broker, whatever, is so important.
Yeah.
Like it's not just from getting you the best deal, but also making sure that overall this is going to end well for you, or putting yourself in a position to win later.
Mm-hmm.
There's people who might be going to get a loan right now, locking in a crazy long prepay. And I'm like, have you thought about?
No, you don't want to do that right
opportunity?
Now.
Yeah.
Because if rates go down in the next year or two, you want to be able to refi into the lower rate.
Yeah. I think in the residential side, I see that. And I talk about this openly is, we have these non-QM products or DSCR rates, and people are locking in a 5-year prepay. And I tell people, like, do you understand if rates drop in a year, or let's say it's a year and a half, like what are you thinking? So I'm really like, I would go 1-2 years. I tell people that's it. I'm trying to do, especially now, 1 year, because I'm like, you want to have that opportunity.
Yeah.
You'd rather, trust me, you're going to wish you pay the higher rate.
Yeah.
So a lot of people are going to have a lot of regret. I think people are going to put themselves in a worse position just by not having an advisor, banker, whatever, LO, right? And that's what we're kind of seeing. Let's talk about, I think, one of the big things here is why we're talking today is we care about giving people information, but we also have been doing this a long time, And I think it's really important at this point in time, whether you're at a bank you're happy with, or you're at a First Republic where you're not sure how things are going to, the outlook, which is bummed. Full disclosure, that's where I bank, as you know. And a lot of people are searching. I'm getting calls, you're getting calls, they don't know what to do. But let's talk about really the importance of working with a really good bank, but also, I think more importantly, a better banker. I'm almost like, I tell people, I think a better banker can make make or break you rather than a bank. Mm-hmm. The thing that I don't like about the big banks is we came from a big bank and went to a smaller bank, is because it's like a revolving door. Like we literally were at another bank, and I think we've had 5 different bankers, which is insane. Mm-hmm. So you can't build a relationship. They don't really get to know who you are. And then when that is they don't understand your business model and how to really help you. And then when, shit hits the fan, or you need them, like you said, is they need us. Sean's off to the next, Sean's not here, or Tommy's not there, or George is there. I'm like, dude, I had the relationship. Now it's this new guy. I'm like, you don't know anything about me. You're not going to go to bat for me. Mm-hmm. So not only having the talented banker, let's talk about why these regional small banks, just like yours, are just so important for the community, and how you're making, how they're making a big difference and an impact, and why they're actually almost, I think, more important than the big banks. And even if Jamie Dimon was sitting in the room right here, he'd agree with us, 100%.
He probably would, yeah.
He already said it, because we need the small banks. So nothing against the big banks, but look, if you are just a normal Joe and you have a W-2 job and you don't really care, cool. But if you are not that, and you're a business and you need a Sean in your life, how do I find a Sean? What questions do I what questions I'm asking Sean here, and why, what's the difference,
Yeah. And I think your question ties back to our conversation about, are all the community banks going to eventually be consolidated to the big banks?
Yeah.
And we talk about it as if the media is going to have an impact, and the government, and it's just going to happen. But in reality, it's the client's decision, right?
Yeah.
And you and I have seen in our careers that sophisticated real estate clients, business owners, they were at big banks before.
Yeah.
And they have found and selected community banks to serve them for the responsiveness, the access to decision makers, the flexibility on a prepay.
Yeah.
All that stuff is super important to them. And they want to know that if they have a new business idea, or they have a new thing they're going to do, that they could call their banker and run it by them and see, what their feedback is, right?
Yeah, that's a great point.
So I think that's kind of what you're getting at, is the importance of that. So I know for me, I always coach people. I say, I don't want to know who your bank is. I want to know who your banker is.
Yeah.
So if you can't answer the question of who your banker is, then you need to listen to this podcast first of all, right?
Yeah.
And maybe start asking your friends and people that you trust and that you think are successful and you respect. Hey, who's your banker?
It
just came to me in a dream that I don't have a banker. I just have a bank. Who do you bank with? And start interviewing some people. And the questions to ask them are, what do their clients look like? Do they have clients that look like you?
Yeah.
Right? And then dig another level deeper. Hey, I personally like to get my loans structured like this, or I do this kind of real estate development. I do fix and flip, or I'm just a buy and hold person. Do you have clients like that? How do you structure their loans? right? And then, what's your technology platform? I need to be able to do everything on my phone and everything. Like, what does it look like? And just start asking the questions about how you do day-to-day banking. And then there's a likability test, right? Like, you want to like the people that you're working with. I only work with clients that I like, right? Because I put my heart and soul into what I do.
Yeah, that's a good point.
And I give them everything. Yeah. So I want it to be somebody that I like and that I feel like is grateful for all the work that I do and all the advocating that I do behind the scenes, right? And so as people are just interviewing bankers, you kind of want to know if they're in your space. And then the other thing is like the bank. Like, does the bank like the clients that like what you are? And I mean, this is a little bit technical, but if you're a business owner and you have a 10-year plan to sell and you have a strategy and you have different phases of that growth, and you run it by your banker and they're just like glazing over and they don't know what you just said, maybe that's a bad sign.
Yeah.
But if they understood what you said and they add on to it and they're like, wow, and they're starting to give you feedback, now you're starting to get a little bit of a consultative interaction. That's probably a good sign too, that this is somebody that's worth working with. It takes a long time in banking to really learn the craft. So,
I'm sure. Yeah.
I mean, I would, for people that need a high-performing banker, let's look for a vice president or a senior vice president title in front of the name that just shows you that the bank, has some level of respect and they have some level of authority. And let's talk about authority in banks. Not every banker has the same level of authority, and not every bank allows their lenders to have the same level of authority.
I agree with that, yeah.
So if you rely on loans from banks, you better find out who does that banker report to when they're making a credit decision. What part of the credit process are they? For me, I take in financial package, I underwrite them myself, and I go direct to the decision maker, and we make a loan. There is no bureaucracy, there is no red tape, it is straight there. But not all banks can do that, right?
Yeah.
Like some banks, there's layers. You just want to understand what the process is and what the layers are.
Yeah, you made a point where I think you said something like, it's also you do a lot of back end.
Yeah.
And that's, for me, is when I think small community bank, I'm thinking in my mind, because we utilize them for lending, I just think that I know I can call Sean, I can give him whatever he needs, and Sean's going to call, have a meeting, walk down the hall, and talk to this person. And I know that Sean knows his stuff, has a really good relationship with this guy, but that person that they're able to go talk to might be a chief credit officer that's like, this is the decision maker. Yeah. Even though he might go, Sean, we're going to do this, it's still got to go through underwriting, but you got my blessing. That's good. The problem with bigger and bigger banks is, like Sean said, is there's a Sean, but they might have to go to 2 people, 3 people, 4 people. And so when you have to do that, there's layer. Yeah. But the 3rd, 4th person, they're like, they don't know you.
No.
They're not going to bat.
Might not even be in the same state.
Yeah. So
they never saw the credit until it got on their desk, and they never would have done it anyway.
Yeah.
So all that was a waste of time.
Exactly. So I think for me is, even with me, is the lenders I do business for wholesale, I have my rep, but I also have made relationships with not just an underwriter, but head underwriters that actually make decisions of all these lenders that are at the top. Yeah. And I specifically spent the time, energy to get to know them. And when I go to their bank or their lender, for example, I'm like, where is this lady? Cool. I want to go meet her. I want to shake her hand. I want to talk to her. I want to joke with her. I want to get to know her.
Yeah.
And then because when I call her, she's like, oh, I'm like, I have a question, and I know I can ask these people, but you're going to be the ultimate decision maker. Just, what do you think?
Yeah.
Okay, you can give me X, Y, Z, we can do it perfect. Then I come back to the client and say, hey, look, the decision maker said this, so let's go through underwriting, but I didn't go to this person, I went to there. And that's what you get to do. That's really what small banking means to me, is you can make a decision, you can make it fast, and then the more you get to know a client, the more you get to understand them, and the more the client gives you, you guys give back. And this is how deals get done, businesses get funded, and you kind of like, wow, I wonder who did that deal locally.
Yeah.
You ever say that when you drive by something?
That's what I love. That's what I love about my job, is like, I'm fortunate to be at a bank where they care what my opinion of the client is. They care if I have a good feeling about it. They care if I trust the client. And I get asked that question all the time. And then I can go to bat or not go to bat for a client. Now, there's other bankers that they don't have that environment, but they're still technical experts and they know exactly what deals are going to get done and exactly which ones aren't. So I don't want to say that you have to have that level of connection to be a successful banker and to perform well for your clients, because you don't.
It helps you.
For
sure. It makes your life a little easier.
Yeah. But
because if you get the other guy's like, it doesn't fit in my box, you can go, it doesn't fit in my box, but I think we can make the box bigger for you because of XYZ.
Yeah.
That's a little different.
And
there,
particularly with most of my clients and some of yours too, their income is very complicated. And it can be cyclical. It's not cookie cutter every year.
Yep.
So you got to really understand what their business strategy is and how they've executed on that in the past and what the lumps of income look like and what the types are. And so that's when it just gets to be so much more of an art than a science. And a lot of commercial lending is art. It's not science. And that's what
I agree.
It's not numbers on a spreadsheet.
That's why when you tell me you bank, you help 50% of your business real estate investors. When you're a real estate investor, not every year is just you're dominating.
No.
But not any industry every year you're just dominating. But there's also like you can look at a track record and say, yeah, of course this is slower but hello, this is why. It's easy. It's not that, hey, he should be cranking and he's slow. What's going on here? It's, and you're riding the highs and lows with them. Mm-hmm. But if they're good at what they do, the highs and lows aren't as bad, as bad. It's not so much like this. They can you guys can help them go.
Yeah.
And so, let's talk about ending here. This has been really good, but let's talk about. I think it'd be cool to talk about real estate investors for a minute.
Okay.
And kind of like what kind of stuff you guys offer, but what has been helpful to your clients. I think there's people that buy real estate that we know they put the money down, they buy an apartment building, they're good. They have enough money. Then there's some people that may like, hey, I need a little more creative financing. Maybe that's lines of credit or they need to tap into this, and that's good. And there's maybe somebody over here these people are all seasoned, but they're kind of doing more difficult deals, fix and flips or building or this or that, right? And I think you have your strong guy. It's like, hey, I got the money. I put the money down I need and just give me my loan. And I bank with you. I got the next guy that's like, I need to go leverage some things to go buy this building. A little bit more technical. And then this guy is I'm building and doing stuff. Maybe a little bit more out of these comfort zones of these two guys, but he's still talented and good at what he does. But it requires you to be like a little bit more, maybe you're like risk-based financing just because he's doing different deals. It's not so straightforward, right?
Yeah.
How are you helping those kind of three individuals? Because I'm guessing you're probably helping like those kind of guys.
So we start with the who, like who are we lending money to? We don't care about the project, collateral, none of that.
Okay.
Who is the person and how do they make money?
Okay.
So I have examples of people doing higher risk things, fix and flips in this market, right? That's riskier than it was a few years ago. But they've got properties that have steady cash flow. They've got another consulting business over here, and there's other streams of income. And they were smart enough to build some liquidity on their balance sheet. So they're over here doing something super risky that seems like, why would you lend on that? Well, I know that they don't have to be successful on that one project to pay me back. Okay. Really cool example. I've done a couple of these this year where the property doesn't have any income. It's like a hobby place where people store things and go do whatever they want to do, but there's no tenant. So that would just kick it out of most banks, right? Well, you got to dig deeper. Maybe that borrower is a 50% of an owner of a company that cranks in cash flow and maybe they don't have any debt. So now it makes it very easy from a global debt service coverage ratio to do that deal. But I think the moral of the story is all income streams are not created equal.
Okay.
Right now, if you're a pure developer and all you do is development and you rely on the success of each project for your income, that starts to be a little bit, more difficult to navigate for a lender. But
I feel like it's always more difficult, right? Like that's always a challenge.
Yeah, that's always a challenge, right? Because
they're very cyclical. They can be,
Yeah. So I like to see diverse streams of income, and then I can cure all kinds of funkiness on a deal or hair on a deal, like you might say.
And you guys are doing unsecured lines, secured lines. So
yeah, we're still doing
give some examples on that.
We're still doing unsecured lines of credit, full speed for real estate investors. And the purpose of the line of credit is so they can go out and take down properties quickly or put good faith deposits or any moves that they need to make really rapidly without checking with the bank. Line of credit's in place. They're ready to go. They can just draw down it online and go send out their wire.
What are you probably looking for, something like that? I mean,
we're looking for very strong
Give me maybe a line amount and just maybe back into like, hey, Kenny, if somebody requested this line, this is kind of like the profile I'd be looking for. Let's say you like the person too, right?
Yeah.
But, yeah.
So I think the most important thing is you have to have strong income.
Okay.
It can be from a lot of different sources, and we know how to pull out depreciation, all that kind of stuff. Like it's
common sense underwriting. Basically.
Yeah, we know how to do common sense underwriting, but it has to be very strong income. And we kind of stress test our unsecured lines of credit on a 36-month amortization, right? Okay. So if they can make that payment at a particular debt service coverage ratio with their income, then that's probably the biggest hurdle.
So you guys
that's how we kind of size it.
So you guys are like more income driven with things like that, rather than like you've got to have $1 million in the bank to get this, something like this ratio thing?
We do have liquidity requirements, but that could be in a stock investment account. It could be cash value life insurance. It could be cash in our bank. It could be cash in another bank.
Okay.
Yeah, I'm going to want, if I'm going to do an unsecured line of credit, which is the holy grail of bank lending for real estate investment, I'm going to want the primary banking relationship to be
I agree.
me.
They should be giving it to you, honestly.
Yeah,
They're giving,
their money's coming in and out, and like I can, have a relationship with them. But I understand they might have money left at another bank. They might have money over here for this reason because it's in a trust that's controlled by some siblings. Yeah, they have money everywhere, but I just want the primary to be with me. The majority of their liquidity sometimes it might be in their Schwab account.
Okay.
Right? Maybe they got a couple $1 million in there and I'm over here doing my line of credit, but I know they have that liquidity. I know they can scratch a check and pay me back if they get in trouble.
Okay. So you kind of are looking for like that liquidity too, where they don't want to just mess with it. It's there, but you're kind of.
Yeah. Because like a lot of times people, they don't want to pull out of the stock market because they might be on a strategy or there might be a tax implication or something like that. And then a lot of people that I find like more mature real estate investors, they have a target number of cash that they want to have in the bank. And if they don't have that much cash in the bank, they're not sleeping.
Okay.
Right? So they'd rather have that target balance in the bank, use my line of credit to act fast, and then know that I'll come around the back end too and like do a fixed rate loan once they buy the property, improve it, or just figure it all out. Right?
Okay. So just as an example, let's say somebody wants to get $1 million line of credit, right? Can you kind of back into a profile of somebody that you would be like, this is going to be acceptable for me, from cash in the bank to maybe they are a real estate investor and they have another business, right? Can you just kind of...
I'm not going to put myself in a box because I don't have a box that I work in. Yeah. I just make a business decision based on the
who the person is,
type of income that they have. Okay. Is it recurring or not recurring, right?
Okay.
And what their personal balance sheet looks like, what their experience is and what they do. And there's also a likability quotient. Okay. Right? This is a very serious loan. It's unsecured. There's no collateral. Right?
Yeah.
So I have to feel a good level that they're committed to building a relationship with me as well, and that they're going to have money in my bank and that we're going to be able to stay in contact.
Okay. Yeah. So basically it's kind of like if somebody is interested, because I think a lot of people I hear these days, it's real estate investor. Most people like are always lacking liquidity, right? Let's just be, unless you're just Bill, these gazillionaires, right? And they're even doing stuff. So it's, hey, call you, get on a conversation, show them what you got. You can look at everything, come back and say yay or nay. Yeah. And it's not going to take a month to do that.
No, gosh, it's one day. If I have a full package, I could give them like within one day, like kind of where I'm at.
Okay.
But I would say a good rule of thumb is for an unsecured line of credit, you probably should have at least that much in liquidity for whatever the request is. Now, again, I'm not matching funds one-to-one. I'm not saying they have to move all that money into my bank and then I'll do the line of credit. That's not what I'm saying. Yeah. I'm just saying liquidity, access to liquidity. And if you're going to get an unsecured line of credit for this purpose, I would expect that they've had some success in the past, whether it be in business, real estate, something like that. Not like the new real estate investor that's leveraging everything they can to get the next deal, which is part of the journey, right? Yeah. Like I respect that. Yeah. But that's not where we're at when we're doing, a $3 million unsecured line of credit for real estate investing.
Sheesh. Cool. Sean, anything else wrapping up? I mean, gosh, we covered a lot of stuff today. Every time I sit with you, I always learn, because as much as, your side's so much different than my side, I'm not really dealing with a risk. I'm dealing with guidelines. It's kind of like, does it fit in the box? And then maybe we can, go a little bit outside the box.
So regulated on your side.
Yeah. And I get it, because there's so many transactions. Yeah. We're talking trillions so I get it. And Fannie and Freddie, people are like, why don't they lend an LLC? I said, they don't want to deal with that. Like they're doing so many loans. It's just keep it simple. So that's why they can't really have common sense underwriting, because they don't have time for it. Yeah. That's why you got to go to a small bank.
That's right.
Right. So if you guys want small, small bank, common sense underwriting, make sense deals, things like that, that doesn't really come from a large institution. It doesn't go into Fannie or Freddie. Look, that's for your home loan. But if you're business or real estate investment, that's why it's tough, But obviously small banks aren't going to maybe work on every one of your deals too. That's the thing is, like they work on some. So there's people that work at small banks that work with them that I have clients, and they're like, I'm going to go to you because I need more leverage on this deal. Mm-hmm. And so-and-so is only going to give me this. I get it. Yeah. But I'm not going to go get you $1 million unsecured line of credit. Yeah. I don't do that, so.
If you have a good banker that really believes in your success, they're going to do the things they can do for you. You're going to park your money with them, and that banker should have access to other sources of capital, other lenders at other banks. I send stuff to Crystal.
You're good. You're good about that.
I don't need to do all your deals.
No, but you like
Just
to be call me. Just call me. Yeah.
Trust me. I'll be the quarterback. And if it's a deal that's not going to fit with us, then I'll find a home for it. You know,
that's a good statement in on. It's like, that is one thing about, like, you know, having a great banker is, just because they can't do it, okay, call me.
Yeah.
I'll tell you who I know that will get this done. Who's another superstar somewhere else.
Exactly.
And I know that's who you surround yourself by. Like, you know, I always say the teamwork makes the dream work.
Yeah.
So
just to close, I just want to make sure that all your listeners understand that there are a ton of super strong community and mid-sized banks out there that have strong balance sheet, good discipline, good profitability. They don't need to panic about,
and they're lending.
They're lending and they're growing, you know?
Yeah.
We're a $2 billion bank. We've got 6 offices from Beverly Hills down to Coronado.
Okay. You are in Beverly Hills.
Yeah.
Okay.
I work downtown, and we put $300 million of new loans on the books last year. And we did that to local real estate investors, local business owners. We're funding the economy and the local people. That's who we support, you know?
Well, I think, you know, honestly, I can't really, you know, I feel like we covered everything today, but I think for me in closing, I've said this on a lot of my content that I'm a huge fan of small banks, as you know, you know, and it's not that I don't like the big banks. It's just because we're jaded because of what we've done for so long, and we know where we can really help people out.
Yeah.
And it's not that somebody being with a big bank, if you're getting help and that's your thing, great. But we also deal with small business owners from every, you know, you name it, restaurants all the way to, I don't know, whatever, a gas station. And then we deal with real estate investors, you know, and typically those small business owners at a local level want to be able to pick up the phone and call a banker that can say, wire this, do this, something came up, I have a problem with this, there's fraud, whatever. They want somebody. And then on top of that, they need to finance their deals and they need the line of credit to keep their business going. And so that's why the small community banks are here and they're thriving and they're always going to be around. And just if your bank is not lending right now, it not necessarily means they're going to go under. It's a problem. It just means like, hey, they might lend 6 months, a year, and
maybe they're just being disciplined.
Yeah. There you go. Which is not a bad thing. Yeah. You'd rather them just keep cranking and crash. But if Sean can help you, reach out. Sean, where is the best way people can find you, learn more about you, your bank? Maybe you want to have a quick conversation? Oh, yeah. They can just email me at spuckett@calprivate.bank. It's not .com, it's .bank. And Puckett has 2 T's in it. Yeah. Well, Sean, thanks for coming on. And until next time. All right, buddy. Thanks so much. I really appreciate it.
If you're already a real estate investor, you know that aside from cash flow, you also get huge tax benefits by investing in real estate. But are you taking full advantage of all the potential tax benefits? We've been working with Tim Looney at CSSI for a few years now, and he's saved us and our clients hundreds of thousands, if not millions of dollars in taxes doing cost segregation studies on their properties. Let me give you a few examples. We bought a property in 2019. If we had just used straight line depreciation, we would have saved about $18,750 in taxes. But because we did a cost seg, we saved $258,000. That's $239,350 more than standard straight line depreciation in the first year. The other great thing is, if you're classified as a real estate professional, you can apply this to other sources of income like W-2 or 1099 income, and you can also roll over any unused depreciation to future years. If you've owned your properties for a few years already, don't worry, you can still do a cost seg and save big on your taxes. This is not tax advice, so consult your CPA to see if you qualify to take advantage of these benefits. Call or text Tim at 318-469-9861 to get your complimentary property analysis. Once again, that's 318-469-9861. And I'll also include his information in the show notes. You guys don't want to miss out on these tax savings.